It's not a secret anymore that mobile home parks are great investments, and you have the largest private equity groups in the world chasing these and buying them. So Carlyle, Blackstone, like all of the usual names, they're all involved in acquiring mobile home parks. There will be a day, I think it's in the next 5 to 10 years, where they're all gone.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host, and I'm so glad to have you back listening to the show or watching if that's what you're doing. That's great. We have a great guest today, Jack Martin, and Jack's going to speak to us and just have a conversation, educationally speaking, about mobile home parks. We haven't done one of these for a while, and I suggest you take notes. If you're driving, don't worry. We'll have on our basically on our note screen notes for you. So keep driving, keep listening. But if you're sitting down, this would be a really good one to take notes on. so Jack, welcome aboard, man. I'm so glad to have you on the show.
Well, Gary, I'm proud to be with you.
Awesome. Hey, if you wouldn't mind, go back down memory lane a little bit, because everybody's always interested in what got you into this sector of real estate, this business sector, and maybe even what you were doing. Like for me, I was in IT, and just never thought I'd be doing what I'm doing today, but I'm glad I am. So what were you doing when you started this, and what was sort of the inflection point or inspiration for jumping into it?
Gary, I've been in real estate most of my adult life.
Mm-hmm.
I'll go way back to those who were around when cassette tapes were still a thing.
Oh, yeah.
I was in the U.S. Army, and late
Okay.
night TV, there was a Carlton Sheets 12 cassette program that was for sale for like $69. And I bought that cassette series, and much to the chagrin of my U.S. Army fellow soldiers, nobody wanted to ride with me anymore because all we listened to was these cassette tapes. But I became
Yeah.
fascinated with the idea of commercial real estate investment. When I got out of the military, I began a general contracting career,
Mhm.
renovating single family and commercial properties. And then I started buying land and building spec homes. And that kind of led me to my investment experience. Then I started buying single family boarded up vacant houses in the hood.
Mhm.
This was circa 2001, 2002.
Okay.
This was back when you had to go down to the courthouse and pull the microfiche to see who owned it. So
Yeah.
you couldn't do it from your living room. And it began, I think we did about 2,000 single family homes, and they were
Wow.
all purchased individually
Mhm.
through various sources. It wasn't always vacant. Um, and then I got into multifamily, and I thought that was going to be my final resting place to finish out my career. But I
Mhm.
tripped over a mobile home park. So
Okay.
it wasn't intentional, but maybe it's serendipity. We were trying to buy an apartment building that was vacant, and it didn't have enough land for parking. Right next door, there was a small half-acre mobile home park, so I bought it so I could solve the parking issue. Fast forward, the city never wanted that to be an apartment ever again. Today, that's a county office, by the way, or a state forest office. But I own this mobile home park, so that's where I cut my teeth on the asset class. It was
Mhm.
without question the most stable real estate we've ever owned. It just created cash flow to double-digit cash flow. It was amazing, and I was addicted. So I left what I was doing and I started 5210 to focus on building mobile home parks.
Nice. 5210. Okay. I have to ask because people ask me or ridicule me if I don't ask. So where did the title 5210 come from? What's the inspiration for that?
Nate and I are goal-oriented people. Nate's my business
Mhm.
partner. We wanted to
Mhm.
stare at our BHAG every day.
Okay.
BHAG, big, hairy, audacious goal. Our
Yeah.
goal was to buy 52 parks in a period of 10 years,
Nice.
or the equivalent of 52 parks in 10 years. And we're about two-thirds of the way there right now.
Nice. What that's a great goal. If you don't mind me asking, what geographically, where did you get started? Let's go to where was your where were you stationed? What was your duty station? And you probably had at least two of them, I'm sure. And then is that where you started? And then it's just going to be kind of a loaded question. As far as expansion goes, let's take for the first part first, and then we'll get into expansion. So
Yeah,
like,
so I
where did
didn't
it
get
all
into
start?
real estate when I was in the military, but I was
Mm-hmm.
stationed in the 25th Infantry in Hawaii.
Okay.
Schofield Barracks has its pros and cons. Everybody thinks Hawaii is just a beach. Hawaii
Mm-hmm.
also has mountains and jungles.
Yeah.
But I
Mm-hmm.
also did a tour in the Middle East. Didn't see any combat, but got to see a little bit of the world as well.
Mm-hmm.
When I started in real estate, so I live in Phoenix. All of our real estate was local. Initially just in Phoenix, but eventually expanded to the state of Arizona and then eventually into Texas and all the way across to Florida, um, Nevada, Nebraska. But currently, we'll look at properties all over the United States with some exceptions. Want to stay away
Mm-hmm.
from regulatory pressure and rent control and that kind of thing.
Yeah. That's such a vital point. I mean, I know if you just look at the history of real estate regulation and legislation, when I started January 20th, 1986 was my first property. My college roommate and I bought it. We were original house hackers. We didn't hear about the term house hacking until about 10 years ago, but we rented out the other bedrooms to two other guys. And back then, there were the laws were more owner friendly. Over the years, more states, the laws have been shifting more towards tenant rights and away from owner rights. And I'm not making any political commentary, but as far as the business goes, you want to go with the path of least resistance. You want to go where there's, you can maximize upside potential and minimize downside risk. And regulation, just like taxation, is one of those downsides that you want to minimize as much as possible. So the good news is there's still a lot of very strong states out there. In other words, you as long as you do things correctly, you're following the rules, and the number one rule is be a good owner.
Hmm.
If you want to have your business entity set up so you have liability, separation of liability, and then insurance, but the first line of defense is and then insurance is next, and then your business structure. But I'm glad you brought that up because now are there tools you use? Like, can you research the states that are more owner friendly and the ones that are more tenant friendly? Do you have tools at your disposal to help you find that information? Or
Well, Gary, I would imagine that if you had a lengthy conversation with your favorite AI LLM, you
there you
probably could arrive at the truth there. In
go.
this case, like I've been around this industry enough, I go to all the industry events. I've gotten pretty familiar with which states are worth pursuing and which ones are not. Um,
Yeah,
for us, it's kind of between the Colorado Rockies, and the Mississippi River,
yeah,
and then a few sprinkled markets in the southeast.
hmm
And you just stay away from states like Illinois. And
yeah,
it's if they have rent control or there's whispers of rent control, it's probably coming.
yeah,
But to speak on that front, Gary, this is really about, if the owners of properties are responsible stewards of their tenants,
yeah,
we probably wouldn't need rent control. So the challenge that you run into is there are private equity firms that abuse it. They're vultures to some concern.
hmm
And it's all it takes is a couple of those, and then legislation gets forced on the rest of us. So the
yeah,
challenge that you see with rent control is that when it's put in place, and let's say a former owner hasn't been responsible with raising the rent at the property, so it's
hmm
far behind the market, they're still wanting to sell the property at a price that's correlates with how similar properties would trade.
hmm
So the person who buys it is going to be required to raise the rent to justify the purchase price.
hmm
But if rent control is in place, what ends up happening is they can't justify it. So either the property doesn't trade, or what ends up happening is the income is so low that what gets neglected is the condition of the property.
hmm
So particularly in mobile home parks, this is important because you have miles and miles of infrastructure underneath the dirt that provides
hmm
utilities to each one of the individual spaces. And so if you don't properly take care of those and the roads and the landscaping and the lighting and all those kind of common amenities and all those kind of things, what ends up happening is the experience of the resident goes in the wrong direction. And
Hmm.
pretty soon you live in a trailer park. It
Yeah.
started out as a manufactured housing subdivision and it was beautiful. And
Hmm.
it gets neglected because there's not enough income to service it, and it becomes a trailer park. So
Yeah.
the irony in this whole rent control thing is that even though the intent is probably good, the outcome is the person who gets hurt the most in rent control is the tenant that lives at the property.
Absolutely. That's history bears that out, and everywhere we've seen it, New York, California, and some of the larger metropolitan areas, regardless of where they are. Um, if you do the math on it, it's a short-sighted approach that doesn't actually solve the problem. It's a shame. But let's talk about the mobile home parks themselves. So um, I've seen people, most people I know who've done mobile home park investing really are successful, and most of them are leaning more towards being the landowner and are not really getting into the mobile homes themselves. Although some of them have, but I have an old banker's background. I was in banking for a bit too, and we did the math on it, because banks loan money to people buying properties, and they consider it a mobile home, not really not really an asset. It's depreciating, like really depreciating, physically depreciating, versus a brick and mortar home that appreciates in value, and then you get depreciation as the paper write off. But in any case, sorry to go long winded on that. What is your approach towards owning, like identifying, analyzing, and owning the mobile home parks? Is it more land based? Kind of unravel that a little bit if you could.
Yeah, there's two things that really stand out about mobile home parks, and I'll get a little add a little color here so that the answer makes sense. First of all, mobile home parks are, without question, I've been involved in half a dozen or more asset classes. They're the most stable real estate that there is, and there's a reason for it. The
Mhm.
stability comes from the home ownership by the tenant. So
Mhm.
if you think of, let's use the apartment as the comparison. You lease out a beautiful renovated apartment to somebody. Their mindset is this is temporary until I find something better. Whereas somebody comes into your mobile home park and they buy a similar quality, by the way, mobile homes today, if you're inside, you can't tell the difference between a site-built home and a manufactured home. They're beautifully
Mhm.
designed and manufactured in the same way that a site-built home is. The difference is they come in on a frame with wheels, and then they get set
Mhm.
in place versus being built on top of a foundation. But the
Mhm.
experience is the same. Um, but when somebody comes in to purchase a home, they're making a permanent housing decision. Their
Mhm.
intention is to live there indefinitely. It's not a temporary solution, it's a permanent solution. So the mindset is different. They're coming in with a homeowner's mentality instead of a tenant mentality.
Mhm.
And that's what creates the stability. So they're making a vested, or they have a vested interest in the community. This is their
Mhm.
property, it's their park. So you'll see that the turnover, if you look at an investment, kind of zoom out and say what's the most expensive event that occurs for rental real estate, it's turnover. So when you lose a tenant, you have absence of income, then you have to inject money into the property in the form of repairs and marketing and potentially, depending on what the market situation is, incentives to get somebody to come. And then that repeats itself over and over. I used to be an apartment guy, and
Mhm.
our apartment sizes were anywhere from like 30 units to 150 units.
Mhm.
Um, but the length of time that we would keep a tenant on average was only about 10 months.
Yeah.
So out of the 12 months per year, I mean, yeah, you have some tenants that will come and stay 24, 36 months, but then you have that one that comes for 6 and he's out. And you have that constant cost of turnover. Whereas in a mobile home park, when you put a new home in, somebody purchases it, that's permanent income. It never goes away. Even if
Mhm.
they move, they put it for sale, and the next person who buys the home pays the lot rent. You don't have that gap. There's no loss of
Yeah.
income. So it is so stable as you compare it, especially if you've owned other real estate. That's the thing that
Mhm.
really gets you attractive. But if you focus on the park owned model,
Mhm.
meaning I own the land and I own the homes. Now you basically have an apartment, except
Okay.
for it's not as efficient. So you think about apartments, they have essentially four walls, one
Hmm.
roof, 100 units inside those four walls and one roof.
Hmm.
Change that into a mobile home park with 100 units. You have 100 roofs and you have 400 walls because there's four
Hmm.
walls on every home, right? So you think about
Yeah.
just the maintenance aspect there. Mobile homes are not really designed to be rentals. It doesn't mean that you can't be profitable doing that, but you have way more maintenance, way higher maintenance than you may as well just do apartments if you're going to do that. You
Yeah.
still have all the turnover that you would experience in an apartment, and you
Hmm.
lose the stability that you would have otherwise gained if you would have went with a tenant-owned home model where we just own the land.
Yeah. Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part: no selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you. It's interesting. You just really shed some light on something for me that I hadn't really thought about in depth, in the past, but what I noticed over the years and, analyzing, looking, investing and so forth, that certain mobile home parks are really super nice. I mean, people are riding around in golf courses. It's a resort community. They're on the water, just a great old time. And then others that just look like, shambles. And they were pretty much the rental parks. But I never thought about investing in mobile home parks from the standpoint of my client is an owner of their home. They're just paying me a lease on the land, you know? So not only they're not tenants, they have the home ownership mentality, like you said, they're also more likely to keep up and, pay the land lease, pay their electric and gas bills. And, it's just I'm not knocking tenants. I used to be one years ago and I've rented to thousands of them. But the reality is there's more motivation from a homeowner to keep up with the place and keep current on the bills because they don't want to move. They got their home, you know?
Yeah,
So
Gary, it's
now
interesting. The
yeah.
quality, so I'll share with your audience that there's
Mhm.
a star rating in mobile home parks, similar to like commercial real estate will have class A through D. Mobile
Mhm.
home parks have 5-star down to 1-star parks. 5-star gated resort communities, fully amenitized with that's the golf court on the golf carts in the lake and
Mhm.
all that. A 1-star park is a place that comes to mind when people think of mobile home parks. It's the
Mhm.
trailer trash. You wouldn't really want to go there at night. And that's the one where if you buy a home in that community, it's going to decline in value. So anywhere from 3-star and above, which is the focus that we have, so 3, 4, and 5-star parks, you'll actually find something happening here that your banker self wouldn't
Mhm.
have said in the past. These homes
Mhm.
appreciate in value. So
Mhm.
if the neighborhood, if the housing in the neighborhood goes up in value, the mobile homes inside of a higher quality mobile home park will also go up in value. So
Yeah.
the type of resident that you attract when you buy nicer communities and you maintain them and make them nicer,
Mhm.
you attract people that are seeking home ownership, affordable, that they're attracted to the affordability, but yet they still can gain appreciation in their home.
Yeah. I'm glad you said that. Was somewhat remiss earlier because I didn't point out the fact that the quality of material and workmanship has dramatically improved. I mean, just in the last generation or two. I mean, it's startling to see what's possible now compared to before. And the amenities are much greater too. I mean, they're pretty much on par with just traditional stick built homes. You know, the plumbing fixtures, the cabinetry, the carpeting, all
Yeah.
that. So there really is a lot to be said for that. So um, now, as far as back to the geography, the where you're kind of between the Rockies and the Mississippi River. Um, that's a broad area. Um, inside that area, obviously Illinois being to the north, and Texas and Arkansas and Louisiana to the south, and everything, Kansas in between, Oklahoma and all that. Are there any growth areas right now? And I'll kind of pick on Arkansas and Oklahoma because we watch where highways are being built, where they're planning on building hospitals, universities, and everybody's, Tennessee's no secret. It hadn't been a secret for a long time. Alabama is now starting to be recognized, and I knew it 10 years ago when I knew somebody who owned the land there down by the Gulf, and the state built a connector highway between whatever the next biggest city was in the coastal area because they were building a annex for the university system and a major development site. And I started now it's a big statement, but the things I'm going to let the cat out of the bag here. It looks like Arkansas is really starting to get ramped up, and so is Oklahoma too. The only other state I can think of, honestly, that hasn't been developed yet is South Carolina. I don't know why it's just sitting there like a sleeper state. But how are you, when you think of those two states, or what states are you really, if you were to rank them, and I'm willing to be surprised here, of all those states, what are like the three states that seem to attract your attention the most?
Yeah. So I guess it bears me sharing the view is a little different in mobile home parks.
Okay.
And there's a reason why. So there are more mobile home parks knocked over for redevelopment into another use than there are new parks being built every year.
Hmm.
For every one park that gets built, there's 10 parks that get knocked over. And it may be even greater than that. Last year alone, there was only 10 new mobile home parks built in the United States of America. So
Wow.
it's extremely difficult to build them. On
Mhm.
top of that, when you consider that it's not a secret anymore that mobile home parks are great investments, and you have the largest private equity groups in the world chasing these and buying them. So Carlyle, Blackstone, like all of the usual names, they're all involved in acquiring mobile home parks. There will be a day, I think it's in the next 5 to 10 years, where they're all gone. They're all
Yeah.
owned by the most capable ownership, and they're not coming
Mhm.
back. So you won't be able to buy them anymore.
Right.
Texas is the most bullish state with respect to building new ones. So more new mobile home parks get built in Texas than anywhere else in the United States.
Mhm.
They're just the most pro development in giving the zoning. So
Okay.
I've been an Arizona guy for a long time, and there's only been
Hmm.
two mobile home parks built in the last decade of size in the state of Arizona. So it's just really, really difficult to solve for zoning. The whole NIMBYism, which people get, you might get the city convinced to allow you to build a mobile home park, but then the neighbors are going to say no. And then solving for the utility costs. One of the greatest challenges that you have in building new mobile home parks is because their income is low, average lot
Hmm.
rent is $500. Compare that to an apartment, where the average rent is $2,000. I mean, it's a quarter of the revenue.
Yeah.
And then, of course, per acre, the unit count is low. So on the same piece of property, you could build 5 times as many apartment units as you can because the density is really low on mobile homes.
Hmm.
You end up with like 20 times more revenue to the city for an apartment or a condo or something of that nature than you would if you just give the zoning to a mobile home park. The
Hmm.
challenge is that the cities have is they're weighing that, of course. I'd rather have 20 times more revenue. But the other side is that they have to provide police and fire and school and all these services to these residents, and the income that they're getting from tax is less than it costs them to provide the services. So they
Yeah.
lose money giving zoning for mobile home parks. That's why you don't see them being built. So they end up being built in more rural communities or outside of the normal development ring. And then the
Mhm.
challenge becomes solving for utilities. So
Yeah.
it's a difficult thing to solve for, but this is the only shrinking pool of properties, or the only asset class where there's a shrinking pool of properties. So
Hmm.
our aim is not necessarily a city or a market or what's happening in a state. We have identified the there's a couple thousand mobile home parks that we really like and we want to own, and we're just
Hmm.
pursuing those particular properties. So it's a wildly different approach than it would be if my thesis was I want to buy rental properties. Then what you're talking about would matter to me. I'd be looking at those kind of things. So we still care about what's happening in the marketplace. So to
Hmm.
me, the number one thing is what's the median home value? And if the median home
Yeah.
value is not close to 300,000 or more, the challenge you're going to have is you're not going to be able to sell homes at scale. So mobile homes are about 100 grand.
Yeah.
So you need to have a wide margin between the cost of a single family home and a home in your park. Otherwise, it won't stand out as affordable. So that's the
Yeah.
first thing. The second thing is the market should be growing when population and job growth. Like those things need to be present. Otherwise, there's not a demand for affordable housing. So you want to make sure that those three things are present. Then you look at, okay, what is the
Mhm.
regulatory pressure in this market? Because even if the state is favorable, sometimes the market itself may or may not be. So
Yeah.
you still need to do all the research there. But to us, we're targeting a fixed number of properties, and it's not that many. And there will be a day
Yeah.
when that opportunity is gone. So, I mean, for us and our investors, our intention is to buy great properties in great markets, take maximum bonus depreciation, which we can get into,
Mhm.
and then return the capital and keep the coupon forever. That's the game. So it's really playing a tax game on irreplaceable real estate.
Yeah. Yeah. Well, I love the whole strategy. We've still got a few minutes left here. If you don't mind sharing, what are like what is there a formula that you use when you're looking at a mobile home park? Is there a certain size land wise, number of pads per park? Um, you know, and then what the ratio of cost basis versus the rents coming in on the pads? Is there uh, a range, or what's your litmus test for when you're going through the analysis on a park? You know.
Yeah, so generally we're looking at larger parks
Hmm.
that are either of institutional quality or with some rolling up your sleeves, we can turn them into an institutional quality asset.
Hmm.
We're usually 100 lots or more. We do own a couple that are smaller than that, but we own a couple that are pushing 300 lots as well. So we like to be in the institutional space. Quality is important to us, so we want to be in that mid or upper quality. A lot of that has to do with the access to debt. So the best debt for mobile home parks tends to be agency, Freddie, Fannie, and the park
Okay.
has to be large enough, and then it has to be of have minimum quality standards, or you can't get agency debt. So uh,
Yeah.
usually the price tag is going to be 10 million or above. So we don't even really look at an asset unless it's in the same market that we already have a footprint. Unless
Okay.
it's about 10 million and above. So we're playing with a small pool of assets inside of a wider pool. So mobile home parks can make great sense even if they're 20 lots, but we wouldn't buy those anymore. They're just a little bit too difficult to scale.
Yeah. Yeah. Um, Now, what's the length of for your tenancy? So these folks were typically homeowners and not renters. Do they follow the same pattern as the population in general? Like it used to be 7 years was the average length of time someone stayed at a home. Now it's more like 10, even more in some places. And what's the rule of thumb for the mobile home park residents?
Well, I don't know the exact number, but in the
Mhm.
industry average is about 15 years. So the
That's
average
awesome.
length of stay is 15 years. We have some residents in our park that have been there for over 40 years.
Yeah.
Yeah, they still own their house and they've been paying rent and for that piece of land that it sits on for 40 years. So
Yeah.
it's much longer than the industry average.
Oh
than
yeah.
what you would get in any rental product, of course.
Oh my gosh. And this goes back to one of the first comments you made, which is, the average tenant, your average tenancy was about 10 months when you had, traditional rentals. And I don't know what mine was, but I know there was, people, you know, we felt like it was a good day when somebody signed on for another year or 2 or 3 years,
Hmm.
but that was usually at best. I mean, maybe we had two tenants out of all those tenants that stayed 27 years or more years for I knew one person was there 27 years. But in your case, the average is, that's easily, you know, you know, 5 to 15 times more than the average tenancy in a traditional rental. And you have no turnover as a result. Your vacancy rate's probably, barely measurable. And the fact is, in an apartment, you've got to go in and clean and repair and all this stuff. I mean, when people leave, some of them are very good tenants, don't get me wrong, but some of them, they're not going to care for it like we talked about, like a homeowner is going to care for it. So in your case, you don't really care about that. I mean, you've got a home there, and occasionally maybe somebody will just leave their home. Maybe they went into bankruptcy, who knows what, but probably a rare thing. And then at least you get an asset out of it. To me, it's all the way around much better deal. So if you don't mind sharing, I know we're definitely over now, but as far as overhead, so like when I had a bunch of rentals when I first started, you know, we had some really good months. I mean, my net was, sometimes approaching 20%, but those days are long over. I'm just putting down 20%, financing the rest. And so I got a low rate on my loan, got a built in equity already, and I have cash flow. But it seems to me like, you're going to do much better with what you're doing. In other words, the spread between income and expense. Are you paying the water there, or do the tenants pay the water? Like, what is
Yeah,
your ratio of
the
you know,
expenses it varies. I think the industry average one a fully stabilized park is probably going to be about 30% of the revenue is going to be expenses, and
yeah,
that's going to include taxes, insurance, and then maintenance and upkeep of all the
hmm
common areas. So that would be the landscaping, lighting, fencing, roads. I mean, we own a lot of roads. So even though you may
hmm
not resurface them every year, it needs to be a portion of each year's income that's allocated to that project that comes up 5 years from now.
yeah,
And then servicing any other amenities like a pool and spa and laundry facility and sport courts and all those kind of things that every park's a little different. Um, you could see expenses be 40% if you have a lot of trees and vegetation that requires like mowing and all that kind of thing.
yeah,
Whereas some of our parks in the desert, it's just rocks. So
yeah,
you have to weed spray once a year instead of
hmm
trimming trees. You're doing something different. So it really depends on where it is. Um,
yeah,
and then typically in a mobile home park on the utility side, the power is direct billed to the resident, so they all have their own meter and it's
mhm,
direct billed for the amount that they use. And the water and sewer are typically billed back, so for actual use. So we'll put sub meters. There's a main meter that comes into the property, and there's a sub meter that goes to every lot, and they're getting billed
okay,
for their water sewer based on the amount of usage of the water. And then
hmm
trash can be something that every market, every park's different, but
yeah,
typically trash is billed back. So expenses can be as low as 30%, as high as 40%. It
yeah,
really depends on the nuance that exists there. When you're purchasing a property right out of the gate, we like to purchase properties where there's some upside. So I'm not
yeah,
purchasing fully stabilized properties. I'm buying ones that there's room for me to massively improve the performance and stabilize it myself. That allows me to go return capital. So after it's
yeah,
stabilized, I'm going to go put a supplemental loan or refinance and then use those proceeds to return capital to the LPs. So it
okay,
de-risks the investment. And then we just keep the coupon. So I think from
hmm
a kind of 10,000-foot view, when we analyze a park, we're looking for an opportunity to provide mid-teen IRRs to our LPs with a
hmm
with a cash flow that can grow from 2 to 4% to double-digit cash flow and cash returns.
hmm
So, but I think that your audience deserves to hear the best part about this investment is the tax benefit. So
Yeah.
because of bonus depreciation, and it's back to 100% now,
Hmm.
for every dollar invested, you can get between $1 and $1.70 in passive losses on your K1. And there's a little
Nice.
nuance there. It depends on the debt that you use and the
Hmm.
whether or not there's a recourse. But at a minimum, and our LPs get $1 of loss for every dollar of that they invest, and that's where the real
Yeah.
power is.
Oh,
So,
yeah.
especially for somebody who has another investment that they're selling and they're staring at a big tax bill, as long as the sale of that investment and the investment into a park happens in the same calendar year, they can garner losses that they can use to offset, so they don't have to pay taxes on those either. So
Yeah.
it's the tax strategy, I think, is you couple that with the stability. Mobile home parks don't go to foreclosure. I've never
Hmm.
seen it happen
Yeah.
in my decade of experience. If we look back at 2008, at least in the markets that we were interested in, there wasn't a single foreclosure. I mean, think about what was going on in 2008, 9, and 10.
Oh, yeah.
I didn't see
Yeah.
a single mobile home park go to foreclosure. So they're just really, really stable. Um, that's the kind of the whole underlying thesis. But you need
Yeah.
to get past the stereotype.
Yeah. Well, and I think that's happening over time. I mean, more and more people, at least that I know, have been focusing on mobile home parks. And um, so, as far as people investing that they don't have the time that and the expertise that you have to do the identification analysis, um, can how can they invest in you? I mean, how can they get in contact with you, and what's the generally what does it look like? Do they have to be accredited investors? If you can touch on that, we'll make that the
Yeah,
final
sure.
chapter in this. Yeah.
Yeah,
Mm.
so accredited only, minimum check size of 100,000, and then there's additional like improved economics for as the check size grows.
Mhm.
Um, but yeah, if anybody wants to get in touch with us, they can go to our website, 5210.com, and that's the number 52ten.com.
Mhm.
Go to our contact page and fill out a form, and then you'll get a response from me or Randy,
Yeah.
and we'll get on our we'll have a phone call, a one-on-one phone call.
Awesome. So everybody listening, if that's something you should be able to remember and write down if you're not driving, but it's the numbers 5 2 in the word 10. So the digit 5, digit 2, and then spelling TEN 5210.com. And Jack Martin's your man. So I suggest you look him up, especially if you want to invest in mobile home parks. I mean, I like him myself. I do passively invest. I'm kind of a lot more spread out now on my it's just where I am in life, the stage I am in life, and I'm all passive. I don't. Nobody knows who I am anymore, thank goodness. So, but lots of opportunities out there, and I think when you have an asset class that's becoming rare and more rare, you know how the world is. It makes them more valuable. So I would say if you're going to be looking at this, now is the time to start. And look for Jack, go out there and fill out the contact page on 5210.com. So Jack, thanks again for joining us. This was, I know we went a little bit long, but and I could probably ask you a dozen more questions. But I think everybody's got the gist of it, and I really appreciate you doing it too.
Gary, thanks for inviting me, and we can always do this again at a future date.
I'd love to. You got it, man. And for everybody listening, please leave a review. We love your reviews, guys. It doesn't. We don't get paid to do this. This is a community service, but it's fun. I get to meet some pretty awesome people like Jack. You get some great information, but your reviews help us a lot. We really do appreciate it. And thank you for participating. Thank you for listening or watching, whatever the case is. We will see you on the next Massive Passive Cash Flow podcast. And in the meantime, take care of yourselves, and God bless you and all your loved ones.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.